Assalamualaikum warahmatullahi wabarakatuh. This video will explain about bank financial management and its component.
Firstly, we are going to explain the meaning of banking finance. As we all know, bank must have a strong capital, but strong capital will not guarantee liquidity in all circumstances. Bank finance may be defined as the provision of money at the time it is wanted. One of the authoritative definitions is as follows. Banking finance can broadly be defined as the activity concerned with planning, raising, controlling, and administering of funds used in the business. So, what is bank financial management? Bank financial management in banks is the process of managing the financial resources, including accounting, financial reporting, budgeting, collecting receivables, risk management, and insurance for a bank. It simply means dealing with management of money matters. In financial management, we mean efficient use of economic resources, namely capital funds. Financial management is concerned with the managerial decision that result in the acquisition and financing of short-term and long-term credits for the bank. Here, it deals with the situation that require selection of specific asset or a combination of asset and the selection of specific problem of size and growth of an enterprise.
Next, we will talk about scope of banks' financial management. From time to time, it is observed that many banks have been in crisis because of the mismanagement of financial affairs. Financial management optimizes the output from the given input of funds. In a country like India, where resources are scarce and the demand for funds are many, the need of proper financial management is required. In case of newly started banks with a high growth rate, it is more important to have sound financial management since finance alone guarantees their survival. Some of the most important functions of banks are financing decisions, investment decisions, and dividend decisions as you can see at the slide. First, we will talk about financing decisions. Financing decisions is about the finance manager who has to determine about the best financing mix or capital structure. The core issue is to determine the proportion of debt or equity mix, and this is called the firm's capital structure. Here, the manager strives to obtain the best financing mix, or known as the optimum capital structure. Optimum capital structure is that combination of debt and equity where the market value of share is maximized. Next is investment decisions. The finance manager is also responsible for the effective utilization of funds. If the funds are not utilized in an effective way so as to give a return higher than the cost associated with the funds, there is no point in running the bank. So the funds have to be invested in such a way that the banks can produce at its optimal level without endangering its financial solvency. The investment decisions mainly include current asset investment decisions and capital budgeting decisions. Next is the dividend decisions. This decision involves the idea whether the profit is to be distributed or retained. This is also to be based on maximization of the market value of shares of the bank. Hence, the dividend policy is considered the best, which optimizes the market value of shares. At the time of taking these decisions, availability of cash, legal requirements, and certain other factors are also to be considered.
So now I will explain about objective of financial management. The objective of the banks is to maximize the profits. Hence, the objective of financial management is also considered to be profit maximization. There is another objective of financial management, which is to wealth maximization. First, first, profit maximization. This means maximization of the income of the bank. So under this theory, the firm has to produce maximum output from a given amount of input, or minimize the input for a given amount of output. or the bank has to increase the market price of its product or services or to reduce the amount of expenditure. In the perfectly competitive market, the above is really difficult and almost impossible to achieve. It is considered as a short-term theory, and the following are its criticism. First, there's a direct relationship between risk and profit. Second, profit maximization theory does not take into account the time pattern of returns, which is the most important consideration. The third is the objective of profit maximization is too narrow. The second objective of wealth maximization is the second The objective, the second objective of financial management is to wealth maximization. It means the maximization of the wealth of the shareholders. The objective of the company is to create value for its shares. The market price of the equity shares is in turn a function of the bank investment, financing, and dividend decision. The value of the bank takes into account present and prospective future earning per share, the timing and the risk of this earning, the dividend policy of the firm, and many other factors that bear upon the market price of the stock. The market price serves as performance index of the firm progress, and it indicates how well the management is doing on behalf of its shareholders. Thus, the finance manager has to ensure that his decisions are such that the market value of the shares of the company in the long run is maximized. This implies that the financial policy has to be such that it optimizes the earning per share, keeping in view the risk and other factors in mind. Wealth maximization is therefore a better objective for a commercial undertaking, since it represents both return and risk. Risk and return. A bank carries its operation in an environment which is not within its control. It is exposed to all sorts of dangers both on account of internal as well as external factors. Here, the relation between risk and return is analyzed and also outlines the major areas in respect of risk and return, regarding which the finance manager has to take decision for maximizing the bank's wealth. Figure F2 show how decision risk, return, and market values are related.
Now, we will talk about financial management of banks. First, risk management has been a very important component of business plan for the banks, and an undercurrent of risk mitigation and planning has always been part of the banking business. Next, risk-return trade-off. The higher the risk of an action, the higher will be the required rate of return. A proper balance between return and risk should be maintained to maximize the market value of the bank shares. Next, management of cash. Cash is the basic input needed to keep the banking business running on a continuous basis. It is also the ultimate output expected to be realized by the selling the service by the bank. The bank should keep sufficient cash, neither more nor less. The cost of capital. The cost of capital of a bank is the minimum rate of return that it must earn on its investment in order to satisfy the various categories of investors who have made investment in the form of shares, reserves, and surplus or deposits. Capital budgeting. The term capital budgeting refers to the long-term planning for proposed capital outlays and their financing. It may thus be defined as the bank's formal process for the acquisition and investment of capital. Lastly, the return assessment of banks. The return represents the benefits derived by a banking business from its operations. Different financial managers give different meanings to these operations. and hence there are different approaches for the measurement of return. The profit approach means that the return from a banking business is measured on the basis of the profit it earns. That's all from us. Thank you for watching.
Goodbye.